Okay, well, welcome to this webinar looking at reforms to IBOR and the impact on valuation as part of the IVSC's Valuation Webinar Series 2021, sponsored by Duff & Phelps, a Kroll business. Shortly, I will hand over to our moderator for today's webinar. But before we get started, just a quick reminder that this is part of a 5-webinar series being hosted by the IVSC and Duff & Phelps during May. Recordings of the other webinars will be available to download, and you can access these by registering for the IVSC's monthly e-news from the IVSC website at www.ivsc.org. During today's webinar, you will be able to ask questions to the panel using the Q&A button on your screen, and we will also have polling questions to capture your views on certain IBOR-related topics during the session. Finally, the views and opinions shared by our panelists are for the purposes of this discussion and do not necessarily reflect the position of their organizations, the IVSC or Duff & Phelps. Our moderator for today is Kumar Dasgupta. Kumar is the IVSC Technical Director responsible for financial instruments valuation. Prior to joining IVSC, Kumar was a Technical Director at the International Accounting Standards Board, where he was responsible for financial instruments. He's also advised clients on financial instruments accounting at Barclays Capital, and previously was the national partner responsible for treasury and financial instruments accounting for PwC in India. So with that, Kumar, over to you.
Thank you, Richard. And good morning, good afternoon, and good evening to everyone for wherever you are. And thank you for joining us on this webinar today. So welcome to this IVSC webinar on what will IBOR reform mean for valuations. Now, we all know that globally, we are moving away from our well-known and well-established interbank offer rates to alternative rates, risk-free rates. And this move will have a number of implications going forward. Now, it especially impacts the financial services sector, but it also impacts everybody who uses any type of financial instruments. Now, it is an ongoing, continuous, and rapidly evolving process, and has a number of implications. But the challenges that we want to focus on today are those to do with valuations. To address this, the IVSC published a perspectives paper last year on the topic. And the aim of the webinar today is to continue that discussion and also update participants on what's been happening in the recent past in the area. Now, we are lucky to have a significant broad range of panelists with us today who are not only experts in the area, but are people who are dealing with this on a day-to-day basis, the challenges that arise when we look at IBOR reform. We are lucky to have people from various different areas, including banking, advisory, audit, and of course, regulation, which forms a key part of this. Just before we go on and before I start introducing the panelists, I would just like to apologize that we are waiting for Thomas Lee, who's one of the panelists today, to join, and we are hoping he'll be able to join very soon. So without much further ado, let me turn to the panel and ask them to introduce themselves. And with that, can I start with you, Catherine, please?
Yeah, hi, I'm Catherine Adams. I work for the PRA, which is part of the Bank of England. And we supervise the larger financial services firms in the UK. So I'm today mainly talking from a UK regulatory point of view, but I'm also part of the team of supervisors who are assessing firms' progress on LIBOR transition.
Thanks, Catherine. Ben, can I come to you, please?
Sure. Ben Ryan, Bank of America. I run the Global Valuation Group. I am one of those banks, people being assessed continuously by Catherine and her peers.
Thank you, Ben. Marcus.
Hi, I'm Marcus Morton. I'm a Managing Director in the Valuation Advisory Services practice of Duff & Phelps, now known as Kroll. I've got a background for 30 years in risk valuation control and investment banks in New York and London, and I'm leading the LIBOR initiative for Kroll. That's why I'm here.
Thanks, Marcus. And last but not the least, can I come to you, Justin, please?
Good morning, good afternoon, good evening. Justin Keane. I'm a partner with PwC based in New York, and one of the partners leading our firm's efforts supporting clients around the IBOR transition, both in the US and around the world. Thanks, Kumar.
Thanks, Justin. Now, before we start the panel discussion, what we also want to do is run quite a quick few polling questions so that it gives us some information about who are the constituents and what are the key concerns so that we can focus our discussion more appropriately. And also before we start the polling, just quickly to give you a little bit of a roadmap, we will have a panel discussion for about an hour. And after that, we would like to spend the rest of the time to address the questions that come in from the audience. So please do raise your questions as we go along. Okay, the first polling question is up. If people scroll down, you will see there are 3 polling questions there. So the first one is, which geographic region are you based in? The second one is, how do you interact with the valuation process? And the third is, to what extent do you feel your clients are prepared for LIBOR cessation? And sorry, there's the 4th and 5th question. Has LIBOR transition been a priority for you in 2021? And 5th, do you expect it to be a priority in 2022? Okay, people can see the results. So effectively, geography, it seems to be distributed equally between Europe and Asia, and the rest is from North America and Middle East. Primal representation, which is good, is valuers and also reviewers and auditors. Only 9% is telling us that they're well prepared. 48%, they're saying they've started work on the transition, but there's still work to do. And I think, Marcus, this is something you'll be looking at. And we have also got 43% of the constituents telling us they have not at all prepared. It's good to see that 40% is telling us that, yes, LIBOR transition has been a priority in 2021, but there is, of course, the 60% who is telling us that it's no. And obviously, 73% tells us they're expecting it to be a priority in 2022, and the balance, no. Okay, that does give us a fair idea of what we are looking at and what is the task cut out for us going ahead. So with that, can I start with a panel discussion by coming to you, Ben, first? So this webinar on the impact of LIBOR transition on valuation professionals is the last in our series, but has got perhaps the biggest interest so far based on what we have seen. Now, you were the chair of our group that came up with the perspectives paper on LIBOR transition. And so can you share on your perspectives on why you think LIBOR transition is something that should be of interest to the valuation professional and is a priority?
Yeah, I think that this is a stunningly complex, challenging change. And it's a valuation project, it's a regulatory compliance project, it's an operations project, it's a technology project, it's a valuation modeling project, it's a risk management project, and it's a stress test, it changes stress testing. This is an incredibly complex undertaking. And maybe I'm looking at it through the lens of what I see at Bank of America, which is a huge, complex institution. But I think what prompted us to work on the IVSC paper, which you noted, was, a subset of that is, how does this impact the valuation professional? How does this impact what I do? And it impacts it, it's impacting us currently, it's impacting us in the future, and it will continue to do so. LIBOR retirement or transition, the take up of new rates, so it could be risk-free rates, and it could be credit sensitive rates. It introduces uncertainty, it changes the current market. Uncertainty has an impact on valuation. We don't have a reserve for uncertainty, that's not standard accounting. But with uncertainty, you've less clarity, you've wider bid offer. We expect to see a change in liquidity, which you already mentioned, Kumar. So we see a difference in standardized coupon calculations. And even just as a subset, and I could speak for an hour on coupons, some coupons you're going to know in advance. So at the moment, you know your LIBOR coupon, it's available, it's published, you use it. You use it for a 3-month or a 6-month period. And it's easy to consume, it's easy to construct. Some coupons you're going to know at the end of the payment period, and maybe it's 1, 3, 5, 7 days before the payment period, you have a look back, and that capturing that information is that's an operational challenge, but it's also a valuation challenge, and it introduces challenges for us because we're also going to have different coupon conventions for different products. And again, there's a mix of different products, different rates out there, set in arrears, set in advance, different look back periods, because you can't settle on T0 an amount that you only know on T0. You need some time to pre-advise and to agree those payment instructions. So LIBOR is something that's happening now. It touches huge amount of what we do, and that's nuts and bolts of coupons, things that we're hundreds of years into calculating coupons. This is complicating that, and it's into the complex models that we're using for the most complicated financial derivative products or structured note products. So again, I could keep talking. I probably sound like I'm rambling, but I will summarize and say this introduces a lot of complexity through what's going to happen to the existing product set that's going to fall back to different rates. Some of that is clear, some of that is not clear. Some of that will be litigated or arbitrated, and it introduces complexity because new markets have to develop, and we haven't seen all of those yet. With that complexity comes a degree of uncertainty, a transition period, a bedding down period, and that is something that will have an impact on valuation and valuation professionals from my perspective. I think you're on mute, Kumar.
Thank you, Ben. Sorry, and thanks about that. It seems, to put it in a nutshell, you are busy during the day on LIBOR for the time being. Okay, thanks a lot, Ben. Justin, coming to you, I think the poll shows us that not everybody has put this as a priority and there's a bit of work to be done. So given the challenges that Ben mentioned and how much time and effort is going into from a Bank of America perspective, in your capacity, because you are advising a lot of clients, could you reiterate for people what you see as the timelines and where are we in that timeline today?
Sure, Kumar. So since the FCA announcement back in July of 2017, we've really been operating under the assumption that LIBOR would cease to be published at the end of this year. We now have certainty over that. With the announcement on March 5th earlier this year from the FCA, from ICE Benchmark Administration, and from others, we now have confirmed dates as to when all 5 of the currencies will cease publication of LIBOR. And those announcements also triggered the calculation of the fallback spreads, so that we know what we will convert to for those instruments that are subject to the ISDA protocol or similar mechanisms. So for sterling, euro, Swiss franc, and yen, those LIBOR rates will cease publication at the end of this year. Even where we have discussions around sort of synthetic LIBORs being published, those effectively become the new RFRs in term form, plus the same fallback spread that ISDA has calculated for those instruments. In US dollar, the slight tweak being that 2 of the lesser used tenors, the 1 week and the 2 month, will cease publication at the end of this year. The main tenors will continue to be available through June 30th of 2023. However, the guidance from US banking regulators last November and supported by other regulators, including the UK subsequently, is that there should be no new US dollar LIBOR transactions after the end of this year, with some very specific limitations. So if anyone was in any doubt, for sterling, euro, yen, and Swiss franc, LIBOR will no longer be published, will no longer be usable in contracts past the end of this year. For US dollar, I would be clear that the extension of 18 months really allows existing transactions to run off, to continue to use those rates, but there will be no new LIBOR transactions, and the liquidity in LIBOR and consequently the ability to project forward will be likely significantly impaired once we get past the end of the year. Back to you, Kumar.
Thank you, Justin. I think that sends out a very clear message about the timeline and the fact that there isn't much time left. With that message, can I come to you, Marcus, because it clearly aligns with what Ben has also been saying, given the complexity and the urgency of it. And perhaps from your perspective, because you see a lot of clients and also you're involved very heavily on the day-to-day basis in helping clients manage this transition, can you give us your perspectives on terms of readiness and also especially the implications for controls and business operations, because it does have an impact, I believe.
Absolutely, thank you, Kumar. Yeah, the readiness is interesting to see what came back there on the polling question. That sort of jibes quite well with what we've seen, both in some previous polls we've done in other webinars, and that is there are an awful lot of people out there who are not ready for LIBOR. They are still preparing. I think to Justin's point, the announcement, the actual final cessation announcement, I think has given people a lot more certainty that yes, December 31st for the non-dollar currencies is the deadline. I would hazard a guess that some people probably were hoping or perhaps wishing that the regulators might kick it down the line because of all the disruption last year caused by COVID and so on. And I think there was a sort of some people did have that belief, but now the announcement's out there, it's given a much stronger, okay, this is it. Now the clock is definitely ticking down now. That said, I think, in talking to clients, yes, we're seeing quite a wide range of readiness. Particularly the regulated entities seem to be quite advanced in their progress. I think having the regulators obviously putting the pressure on them has moved that along well. Where we're seeing less readiness is smaller entities, small funds or corporates perhaps who have LIBOR contracts, but perhaps don't have the expertise to deal with the changes on their own. And a lot of them seem to be perhaps looking to the professionals, their lenders or their professional counterparties for guidance or ways forward in this. And I think the other thing that's perhaps held up that readiness a little bit is, the detail from the trade bodies around how to migrate a legacy loan, how to migrate a legacy bond. That's really only crystallized recently. If you're talking to someone middle of last year, they would be taking a chance if they were to migrate to what they thought was going to happen, as opposed to now when there's a lot more certainty. So we're seeing a lot more engagement from people around LIBOR now, around sort of putting in place the programs. But I think the point is very important. The clock is ticking. December 31st deadline is not that far away. As Ben says, for a program of this complexity and with this breadth across the entities, that's just not that much time. In terms of the risk and controls, to Ben's point, this is a very, very complex project. Every aspect of the firms involved, yes, trading, yes, valuations, yes, risk, but technology, operations, legal, in terms of making changes to the contracts, negotiating any new terms that need to be inserted, etc. The governance challenge there is huge. Getting it wrong, obviously, the risk would be that you end up with a contract that is not enforceable, is imperfected, ceases to perform the way you expect it to. And the consequent impact on your portfolio, your valuation, and potentially your clients, it could be huge. And I think one of the aspects, which has been brought up a number of times when we're talking to people, has been around the conduct risk associated with this. That people don't want to feel railroaded into making amendments or changes to their deals that perhaps they're not 100% comfortable with. And that's an area I think we're seeing a lot of focus on, in particular, from both the regulators on both sides of the pond. Back to you, Kimmo.
Thanks, Marcus. You do bring in quite a few perspectives on governance and other areas which we will get onto in the next phase. But I think with that, let me come to Catherine, who also represents from the regulatory side, and what her perspectives are on this, and what her expectations are, given what she's seen with the poll and the timelines.
Yeah, the poll was a bit worrying, but I thought it'd be useful to talk about a letter that we issued in March this year, which is one of our Dear CEO letters. And these are letters that we send to industry highlighting areas of concern. And we issued the letter jointly with the FCA for industry. And it really affirms our expectation that the big banks and the major financial institutions need to be prepared for LIBOR transition. And we are asking firms to accelerate their efforts in this space to ensure that the transition goes smoothly. This is one of our top priorities for the year. So we're meeting regularly with the larger firms, and we review the LIBOR and risk-free rate exposure data to assess their progress. But we issued the letter because we felt that not all firms were on track to meet the targets set by the Sterling risk-free rate working group. For those that don't know, there's an industry working group for each of the LIBOR rates transitioning. And the Sterling working group was initiated by the Bank of England as far back as 2015. And its members consist of representatives from all the market participants you would expect, banks, brokers, asset managers, pension funds, insurance companies and corporates, etc. So amongst other things, the working groups set best practice for transition, helping to propose the agreed fallbacks and setting target dates for transition. So the Sterling working group also coordinates with the other working groups in the other jurisdictions, and that's to try and align communications, recommendations, and resolve any cross-currency issues. But I would reiterate what the other panel members have already said, that there's a lot to do, there's a limited time frame, so preparation and early transition is key. Otherwise, the risk is all going to be held up to the end of the year, and all the issues will have to be resolved then. I thought it would be useful to pick out some of the key themes of the letter and some of the key messages of a recent speech by Andrew Bailey, who's our governor, both of which are available for people to read in full on the Bank of England website. The website also has the Sterling Working Group announcements and publications, so it's a good resource for information. So to go back to what Justin was saying, he had the target dates, and we're expecting all the firms to meet the milestones of the Sterling Working Group and the targets of the other working groups. When I say all the firms, I mean the large financial institutions. And we see this as a risk management issue, and the relevant senior managers in the firms need to take responsibility for ensuring that suitable policies and oversight are in place. So this means that we don't expect any new loans, bonds, securitizations, or linear derivatives written by any of the firms that we regulate from now on. The only exception that we've given is for linear derivatives, which is allowed for risk management purposes, and that's for risk management by either the bank or their clients. For example, a LIBOR swap could be used to hedge more complex derivatives risk. I suppose when we're looking at, I think what Marcus was really, I think when we're looking at all the different instruments, we're particularly worried about our loans and syndicated loans, because they seem to have been slower to move away from LIBOR, possibly because they're all bilateral and corporate led. But in all cases, we think that firms should have robust procedures to ensure that new Sterling LIBOR business is closely controlled and signed off. As we are saying, these are exceptions only, e.g. for risk management. And we would expect pre-approvals to be made for all exceptions following a pre-trade governance process. I think one of the things we're emphasising is that all the major banks need to be reaching out to clients now to discuss LIBOR positions, and it's not progressing fast enough. Bilateral conversations should have started, and we expect firms to have made every effort to agree the fallback rates by the end of September. So in addition, firms, and that's hopefully everyone listening, should have prioritised resources to adapt their systems for the new products and the fallbacks, or to have at least robust practical solutions. For most positions, Sterling positions, SONIA compounding arrears will be the fallback. So obviously compounding arrears, as Ben said, is very different to having one single point of forward-looking LIBOR that we have at the moment. And finally, I want to say that firms should be minimising legacy positions. So legacy positions, we're calling those trades where they're very hard to transition. And we put a safety net in place, which is synthetic LIBOR for valuation. But we're seeing this as we want to emphasise this, we hope this is a temporary solution and we're not having to still quote synthetic LIBOR in 10 years' time. Thanks.
Okay, Catherine, thank you for making clear what the regulatory expectations are, because I think that's important for all our constituents, because it helps them also to judge the urgency and the timelines. Now, we will have a short, quick poll now on a couple of other questions, but let me also again ask the audience to post their questions in the Q&A section so that we can pose them to the panelists after the discussion. So before we go into the next phase of the discussions, can we start the second poll, Richard? Okay, as you can see, there's 2 questions. And the first question is, are you seeing valuation impacts arising from IBOR transition? And second, when do you expect to see liquidity develop in the alternative RFR markets in the alternative rates? We will just give it a minute before we start, after we have seen the results of this poll. Okay, that is quite interesting. 23% of the participants tell us they think it's pervasive, but a majority, 50%, half, say it's only in certain areas and others don't think it's there, 30%. Regarding liquidity, and this will be interesting for our panelists, 15% think it's already present, about 38% expected within the next 6 months, and the vast bulk, the other bulk, 46%, say they expected over next year or longer. Okay, that does set things in perspective. And now, coming into the discussion, Ben, I'll turn to you again, because you started us off, and I think the discussion and the introduction does establish the importance and the urgency of the situation. And given this, what I was looking from you is that, as I said, you are the chair of the group on IBOR for IVSC that looks at the valuation perspectives. And before we go into some of the key themes in that paper, what I was looking at from you is that, could you just set the scene of what that paper is trying to do and achieve before we go into some of the key aspects of the paper?
Sure. Thank you, Kumar. I think the paper had a number of objectives. The objectives were not necessarily clear up front. We had an aspiration, which was something profound is happening to the market we work in, and that will have an impact on what we do. We should utilize the IVSC, create a working group, get some expertise around the table, and think through, talk through some of the impacts of what we do. And we approached it, I think, consistent with Catherine's exhortation previously, that there's a element of risk, and there's not an element of risk, there's a huge amount of risk that needs to be managed. And valuation risk is one of those aspects. And the working group was a way to share information, monitor what was happening, to tease out the issues with a valuation focus. So, each of us work for large, complex organizations of different sorts, managing complexity, but the valuation sphere is a subset of what those institutions are doing. So it was good to have a working group, considerable expertise, considerable insight, tracking issues, talking through the risks from a valuation, finance, accounting perspective, not a technical accounting. We were aware of some of the questions of what could happen to hedge accounting. We were not necessarily legal, but we were tracking some of the legal discussions. One of the useful discussions and shows how this working group developed was, and it goes to Marcus's point about the enforceability of contracts. Certain contracts will have a fallback or presumed fallback that says if LIBOR doesn't exist, use the last rate. Now that was never meant to be, we were never envisaging the termination of LIBOR when that was considered. So that would, transform a floating rate instrument to a fixed rate instrument if that happened. So this working group provided us a forum to discuss this and to share some of the industry legal feedback and say, this floating to fixed rate transformation, it's unlikely to be enforceable under US court. So the working group was think about valuation, think about what we do, share insights, monitor what was happening, get different perspectives from different organizations. And I think it was very successful. It helped me do my job better through this period. And I hope it had a similarly positive impact to the rest of the panelists. But again, I could talk for another hour on this, and I don't have that hour, so I'll pause to see if that makes sense, Kumar.
It does. Thanks a lot, Ben. But just having said that, I know I've worked with you on the working group, which has been a pleasure. I also wanted to just prompt you on something which stuck with me when you started working on the working group to see how you could add value with the perspectives paper to the constituents. And you always used to tell me that we need to do something that people can't get by typing LIBOR transition in Google. So I think that was a key driver when we worked through. So how did that help you to guide the group towards where it ended in the themes in the perspective paper?
Yeah, so at the start of the cycle, our information was different forms of Googling, whether it was internal information, regulatory updates from PwC or Duff & Phelps or KPMG. There was a lot of information there. And I think through having the discussions, forming a working group, figuring out what mattered to us from a valuation perspective, it actually allowed us to have a focus. And then when you had a focus, you could have an interpretation or a distillation of the issue. And what we tried to do in the paper is say, as I said in the introduction, there's a lot of uncertainty, there's increase in complexity. We expect to see a change in liquidity, market liquidity. We expect all of these things to have an impact on valuations today, the today being someday last year when we issued the paper, when we were drafting the paper and having these discussions, that this is a continuous project. LIBOR transition has partially happened. It is happening today. It will continue to happen for the next year plus. And that's part of what we needed to remind people. We need to look through a Google update and provide an interpretation from a valuation perspective, what matters to us. And at different times, that was a large list of questions. We found out more information, through regulatory updates, ARC updates, regulatory or legal changes. So New York State fallback, was one of these key events. And, we answered a lot of our own questions. And then we summarized the state of play into the paper. It's still a lot of questions. It doesn't have answers. We maybe have some more answers now than we had then, but there's still a lot of uncertainty. There's still questions to be answered. And I'm sure the Q&A is going to focus on where can you see this market? And I see some of the questions on, I can't see this in Bloomberg. Well, it doesn't exist yet. The nonlinear market has more complexity. So, so I think we tried to provide something more insightful than a summary. We came up with a lot of questions, and we're continuing in each of our institutions to work through trying to answer those questions as part of the industry or within our own organization.
Thanks, Ben. I appreciate it. So I don't know if people are familiar with I know this group is because they were involved with part of the perspectives paper, but I'm talking about the constituents. The perspectives paper from the IVSE is divided into 3 key themes. And what I would like to do now is start delving into each of those themes. And with that, Marcus, can I come to you to take us through what in your view, what would be the valuation impact of the terms in existing LIBOR contracts? How does that impact valuation with this change?
Thanks, Kima. I think it's an interesting question, and one which is very difficult to answer because there are so many different variations and outcomes in the process. So you can only sort of talk to it in general terms here. But I think, Ben mentioned that, we have some existing contracts that have fallback language, but language that was written never considering the idea that LIBOR would actually cease to exist. Those will potentially seem to be functional. They seem to give you an answer post LIBOR termination, but in reality, the outcome is unlikely to be something that's practicable or as Ben mentioned, enforceable in the court if your floating rate note suddenly becomes a fixed rate note or whatever. So the first question really from a valuation perspective has to be what fallback language is actually in your contract. What is that enforceable? If it's not enforceable, it needs to be revised and updated, obviously. But then once you actually have fallback language that you think is going to work, the evaluation impact will then depend on how that's implemented. And there's still some conversations going on. And one of the areas I think where I sort of look at the valuation question, and we've spoken to clients, is when you have a portfolio of multiple asset types, so maybe a blend of bonds and loans and swaps at a very simple level, there may be differences between the way each of those migrates. Maybe differences in the compounding, differences in the timing conventions, the way that the transition spread is calculated, because a lot of these, particularly in the bilateral loans, will be agreed in the bilateral contract. Whereas perhaps if you look at something simple like linear swaps, a lot of it is maybe going to be picked up within the conversion protocol, which means it's a much more consistent process. But that difference could lead you to hedging effectiveness problems in the reporting. It will obviously potentially lead to some level of value transfer, although I think there's quite a lot of effort being put in to try to minimize that sort of potential sort of difference in values. But inevitably, with the interpretation, with the averaging mechanisms that we see in some of the calculations, there's going to be some value change and changes in the way that the cash flows operate in the future, which will impact your hedging, your hedge effectiveness from an accounting perspective, and so on. So I think it's, looking at those terms is going to be absolutely critical. And as I say, particularly when you get to the bilateral contracts, because those are bespoke contracts, albeit that, hopefully with a fair amount of standardization, there is going to potentially be differences there. And understanding those differences and how those are interpreted in the modeling and the cash flows is going to be absolutely critical to making sure that the transition works, and that we don't end up in a vast sea of litigation on the other side of this.
Thank you, Marcus. So one of the key risks that you're also pointing out, that in top of the valuation, when you look at it, you have also got litigation risk involved.
Potentially, I mean, anytime there's a value change caused by some external thing where people have a disagreement over the interpretation, there is the potential for litigation. Obviously, that's, hopefully, with all the work that everyone's been doing in terms of trying to normalize how this is done and reach standard approaches, that mitigates that to some extent. But ultimately, if there's something that comes out that hasn't been agreed or they're unable to come to terms with, that's sort of usually where it ends up when there's money transfer involved.
Thanks, Marcus. Just can I remind the audience that they can submit questions to the Q&A box, and we will try and address them at the end of the discussion. Now, Ben, can I come back to you? And I think our polling question also shows the different expectations, and the paper also touches on what are the valuation impacts of the evolving liquidity, both for decreasing for existing LIBOR and maybe the lack or not so for the new RFRs.
Yeah, Well, liquidity informs valuation. The more liquid something is, generally, the easier it is to value. The less liquid, the more extrapolation, the more guesswork, or the less empirical evidence to support valuation exists. So I think, as Marcus laid out, there will be different fallbacks. So different markets are going to evolve, different products are going to evolve. This becomes more complex when you've a bit of a divergence between your swap from your swap hedge from your loan or your debt instrument, should you have a portfolio like that. We also hear some anecdotal evidence that there's a premium for bonds with good, clear fallback over bonds with uncertain fallback. Maybe the fallback uncertainty is reducing as there's more legislative options or more clarity and safe harbor rules being added in various jurisdictions. But yeah, I think that liquidity impacts market, LIBOR transition impacts valuation and liquidity, which will change. You will have instruments which become legacy instruments. Maybe they will be traded on an exception basis. You will have instruments that are easily standardized at the moment. Maybe they become less standardized. Your hedge, as Marcus noted, your hedge, which gives you good hedge effectiveness today, maybe you've some divergence between the cash flows on a standardized swap versus a standardized loan. And you're going to need a non-standard contract because you want to align your cash flows. That perhaps, that's going to be the non-standardized product is generally less liquid than a standardized. So liquidity is changing. It's something to monitor. It's something to understand. And I think consistent with what all of the panels have said, each of us need to understand our risk and understand the change that's going to impact us.
Thanks, Ben. You did mention that you are seeing some impact based on the differences in the fallback language. Can you just expand on that a little bit?
Sure. So say and it's one of Justin's themes as well. So I'd ask Justin to step in, is that different jurisdictions have different ways to amend contractual terms in a bond, for instance. Whether you need 100% approval by the bondholder, whether you've minority or 50+1, and it's very difficult to change the contractual term, including the coupon calculation on certain instruments, and where you're heading towards a degree of litigation. That's going to be a drag on valuing those instruments. So some of what, say, Justin has shared in the working group is that it may be easier to call because you can call with a different percentage of bond and replace or reissue with a different coupon than amending the coupon. So I think investors are becoming sensitive. They're discriminating between the nice clean fallback that is easy to process or navigate through a transition, and something that is actually going to require the involvement of lawyers. Sorry, there's some building work happening here in New York, so occasionally you can hear some noise. But the involvement of lawyers, great for lawyers, but it adds expense, it adds complexity, it indicates a challenge. And this is anecdotal, where we're not seeing, this on a profound basis, but we're hearing more of it, and people are trying to, the market is more sensitive to these questions and challenges year over year. I mean, I would ask Justin, who I think has a tremendous insight on some of these themes, to fill in some of the gaps I may have left.
Thanks, Ben.
Thanks, Ben.
Yes, I'll come to Justin next on this one. Justin, if you could take up, I think the theme that you wanted to talk on was what are the new risks that are coming up?
Sure. And just before I hit that, maybe just to follow up on Ben's point, I think what we've seen from some, for example, in the asset management industry, is as early as last year and some slightly earlier, you had people looking at, as they make new investments, did they want to make sure that those investments had the appropriate fallback language in them so they weren't loading up on assets that would continue to be problems. I think we've seen in the US those that have New York State governing law and can take advantage of some of the legislative things that have gone through, have seen benefits from that. But to summarize maybe Ben's point, I think it comes down to people looking at what will happen to those instruments, what will happen to those investments as we go through cessation, to the extent that there is certainty on how those behave. That helps make them more appealing. The greater the uncertainty around how things will behave, the greater the risks and litigation around how those cash flows may be amended, that reduces the appeal, and that will, I think what we saw from one of the earlier polling questions is you're starting to see some of those liquidity and valuation impacts coming through on the assets. The third part of the survey of the piece, Kumar, that you wanted me to touch on, I think was really around sort of the new risks that are emerging. And maybe one of the simplest ways to think about that is just that for many of these reference rates that are going to replace the IBORs, they're overnight rates. They're published in arrears because they're based on more real transactions. And so what we have is instruments don't typically pay coupons on a daily basis. There needs to be some calculation, and the transactions pay coupon as a function of the fixing, not just the fixing itself. As overnight rates, they don't have the implication of term banking sector credit in them. And so those factors all feed into the way that people look at valuation, but that we see value coming through in the cash flows. So, on top of that, you've got slightly different conventions across and within asset classes. So, for example, I think we mentioned earlier, standard conventions for the cleared swaps are going to be a 2-day payment delay. But if you've got a loan product and you're trying to get a hedge that matches that exactly, you may have a more customized swap that aligns the cash flows on a 5-day look back or something like that. So there may be differences in valuation to reflect both the timing and exact nature of cash flows, as well as just liquidity in those setups. For those products that are looking at option payoffs, because you've got overnight rates, effectively you're averaging the underlying reference rates in terms of the payoff. So all of those have Asianing features rather than just a straight European payoff, for example. If you've got valuations that rely on expectations of how borrowers may respond to changes in exchange rates, to changes in interest rates, those may need to amend as people develop behavioral responses to new rates and how those go through. So new risks from the new products, new behaviors will have to not just adapt what we did before, but really think about whether that makes sense and what needs to change. So Kumar, I think clear impacts to models, to calibration of those models, uncertainty around prices, and we're likely going to see evolution of that past the end of this year, going into 2022 and beyond.
Thanks, Justin. That does put things in perspective and bring together quite a few of the areas. A lot of the areas, I think, Catherine, you're well aware as the regulator, and you know what are the impacts. And so can I just come to you? And I think as a regulator, you are expecting robust governance. You mentioned that around this process. So given the challenges and the issues, what would be a regulator's expectations in this area?
Thanks, Kumar. I mean, even though there's limited time frame left, we expect institutions to demonstrate robust governance over every aspect of the transition. So all of the institutions that we monitor have LIBOR transition committees, and they review all aspects of transition risk, including the monitoring of a number of key KRIs. And these include things like monitoring LIBOR positions, outstanding notionals, and the maturity profiles of the LIBOR risk, and the projected and actual roll down of this risk through time, the monitoring of the progress of the systems development. Obviously, systems need to take into account the new conventions, And also they need to identify positions which may be harder to transition, so the legacy LIBOR trades. And we think all of these KRIs are important and firms should be monitoring them. So the committees that we see should have senior management representation from all the relevant functions, including finance. And finance needs to be really aware of how the changes in models and the rates and the conventions will affect valuation and risk. So model changes for new products and rate conventions should go through normal approval channels. So we hope there's good model governance, and new product approval forums should sign off any new products. And firms should make sure that they can understand the new valuation basis risks and liquidity issues, and they're captured in their valuation adjustments and the uncertainty assessments that they make, and they should be included in management information for visibility. And where trades transition to the fallback rates, where we understand there might be P&L impact, the new trade P&L should capture these material changes and should be visible for management and have commentary. And finally, I'll just say for the legacy LIBOR positions, they need to be tracked as well, and the valuations with these positions monitored and highlighted.
Thanks a lot, Catherine. I think that does give a lot of focus for the constituents who have joined the webinar. Now, given governance, the risk, and what you're talking about, it brings me back to another area where some of us are pretty familiar with, is the audit. Entities need to get this transition to not only go through the transition, but also get the results and all of this new elements audited and get their auditors comfortable. And with that, can I come to you, Justin? From an audit perspective, what are you expecting? What evidence will make you comfortable that the client who you're auditing has done this right and you're comfortable as an auditor to sign?
Well, my first response would be that management's responsibility is to get it right. So they should be going through this process for themselves, and the audit will provide a helpful check on that process. I think as we talk about sort of the valuation specific aspect of this, there's probably three things I would suggest that could be helpful for people. Firstly, as is probably clear from this discussion, the valuation issues are pretty complex, they're pretty nuanced. It will likely not be a one and done, right? We're going to be evolving this as we go through the transition, as liquidity continues to emerge and so on. So we should go in with that expectation. So as markets continue to evolve, I think it's helpful to encourage people to think about telling the story on what you're doing, what decisions you made, and why. Secondly, to help with that, I think one of the things that we often see as I work with clients, both on the audit side and with our non-audit clients, is that people may tend to conflate what we should be doing with what we are doing practically as you tell the story. And so I would really encourage people to think about that as two separate points, right? One is, in an ideal world with ideal information, unlimited resources, what should we be doing from a valuation perspective on a given topic? And then separately bifurcate that from, well, what do we actually see today? What are the limitations? What are the approximations we're making? And I think sort of keeping those two components separate will help explain what one ought to be doing and justify what decisions we're making in the meantime. It'll help you clarify what are the things you should be looking out for and what mitigating controls need to be put in place to monitor developments and maintain good governance. And then thirdly, the last thing I would say is just writing it down forces crystallization of thinking. I think this group saw it ourselves as we went through the IVSC paper, but actually it is actually helpful to try and start writing down some of the decisions and thinking about how you would tell the story. And I think that can help you crystallize a more robust decision-making process and a well-articulated thought process to support management's assertions around this.
Thanks, Justin, and I appreciate that. I think we are almost coming to the top of the hour, as when we said we would be opening up, going into the section on the Q&A. And since we are there and we might lose some people, can I come back to each of you and I'll go through to sum up, in short, what would, in your view, be the key takeaway for the participants in this webinar? Can I start with you, Marcus?
Sure. I think the key takeaway is something I've been saying to a lot of the clients I talk to, which is you need to get started. It is, it really boils down to that. Is people, like we saw in the poll, there's a lot of people who haven't really got prepared. They're not ready. They're not, in a position to do it. We're, just about to hit June. The deadline for the non-dollars is the end of this year, and that's just not that long for a project of this complexity. I know that's not a valuation issue particularly, but clearly, valuation's in there. But this is a project that requires a lot of work, a lot of thought, a lot of preparation, a lot of governance. We're about to we're coming very close to the end of the second quarter. And if you haven't started now, you are, I think, as Catherine mentioned, one of the things we don't really want is everyone trying to do this in December. Aside from anything else like that, it's, a lot of people will be on holiday, but also it becomes a lot harder if everyone is trying to get their IT upgrades done at the same time. If they're trying to sort of do the negotiations at the same time, it's going to put a huge strain on what is going to be a fairly limited amount of resource. So the sooner people can get started, the easier this is going to be and the smoother it's going to be for everybody.
Thanks, Marcus. Ben, can I come to you, please?
Yes, I think we've covered most of what I feel, but I think that I'm a professional paranoid worrier. One of the things I worry about is basis risk, tail risk, liquidity risk. They're not small items. And I think recognizing that this transition has a change, maybe we're not sure of what the change is, but you're going to be introducing basis risk. You're going to see a change in the liquidity profile of the markets. There's going to be unforeseen consequences. There's going to be a degree of tail risk that you're going to manage. And I think consistent with what Justin just said, and Marcus and Catherine and you, Kumar, we're telling people you need to be risk aware, you need to own this, and you need to understand the impact. And if the impact is unclear, you need to recognize the risk of it currently being unclear. And you need to have those questions. And I think one of the benefits we've got out of the IVSC work we've done is that it's highlighting, valuation, there's one number on the ledger. And what do you have supporting the number on the ledger? The uncertainty reporting, the risk of the risk of different options occurring. You need to enhance your reporting to management to cover these risks, to identify these risks. Maybe you don't have the answer, and it will be late, as Marcus just said, if you're starting this in December.
Catherine, can I come to you next, please?
Yeah, so I'll just reiterate what everyone said. This is a 2021 issue, not a 2022 issue, unless you've got complex litigation, which one hopes you don't. So we're generally concerned that everyone is relying on the fallbacks without really understanding the implications of valuation risk. So early transition is key. So get looking at all your contracts and understanding what the fallbacks mean. It's a complex project, so we need robust governance around all aspects of transition, especially valuation risk. And I think Bank of England website is a good resource for sterling LIBOR publications. I think some of the other websites are good if you want more detail.
Thanks, Catherine. Coming to you, Justin, now, please.
So maybe a mindset to help go through the points from Marcus and Ben and Catherine around getting on with it. I would say also don't assume things are going to get sorted or that conventions will solidify, or it can be a fast follow or wait for things to emerge, right? I think those that have got into the challenge around this have continued to find it's complex, it will evolve. From a timing perspective, everything will not be settled in enough time for you to wait for that and then make your transition. So it won't be perfect, but in the words of Stephen Hawking, without imperfection, you or I would not exist. So I think get going, identify the risks, manage the risks, ensure good governance, and there will continue to be evolution as we go through this process and as the new products continue to cement themselves past the cessation dates.
Thanks, Justin. And thank you, everyone, for sharing your experiences, your views, and also very specially for giving your time. I think I'll impose on you for a little bit longer as we go through some of the Q&A that has come up. So I'll try and group the questions together. And there's one specifically for you, Justin. So since you were the last speaker, one of the questions that have come up, which is interesting, is that what do you think about the risk of litigation? How high do you think that is? And for December 2021, how would you fix it? Means, assuming, what would your recommendations be to the groups or the groups related regulators who are coming up to try and reduce this litigation risk? And Marcus, I will come to you. I'm not letting you off the hook on this one as well.
Yeah, and maybe Justin should acknowledge that he does in fact have magic power before he answers, but.
Yeah, unfortunately, that's not the case.
Don't be modest.
I think as you go through this, right, sort of, there is, Catherine made the point around sort of the proactive modifications. If you can get agreement, this doesn't work for every situation, but if you can get agreement between well-informed parties in advance, you can migrate onto new constructs. That is helpful. That can help move you forward, and there's not then a break that causes that litigation process. I think the ability to reduce litigation risk to zero, unfortunately, I do not think exists. I think you've got significant efforts that have been going on through safe harbors and legislation in various different jurisdictions to try and demonstrate that what we're trying to do through some of the full WAC protocols under ISDA and other working groups is get to as equitable a solution as one can when the rate is going away, when you will not have a forward curve on LIBOR to manage against. It's not trying to take advantage of one party or another. It's trying to say, look, what's an equitable, reasonable, operational way to come through and as closely as possible replicate what people signed up for in the first place. Those risks will still remain, I think, regardless of what happens. There's still time and effort that may be involved, even if litigation is unsuccessful. But if you can get off the trend, if you can get off the exposures ahead of time, that is probably the best way to go through and remove the litigation risk. I think it also reduces your operational risk. And then we continue to hear from clients that are looking at how would I actually operate mass changes to in-flight contracts in systems right over year end. It becomes a really unappealing idea. So we may have to do that, but as much as we can mitigate the volumes that have to go through that process, the better, I think.
I think somehow, due to some technical reason, Marcus seems to have dropped off. Anybody else wants to add anything from their perspective? Ben, Catherine?
I think that some of the questions here are pretty practical, and you know, the development of a term rate versus the development of a spot rate, you know, that is work in progress. So the forecasting, the depth of the market for a term rate, what are the term rate standards, you know, that is being negotiated, resolved across the market. So one of the I suppose the guiding principles of IBOR replacement has been that we need to have something that is based on transactions. So the fixing is transaction based, not survey based, not opinion based. And we're fixing focus, i.e. spot focused, from my perspective as an industry. And I think that the term rate has yet to develop, and you know what sort of term rate will develop, don't know. I think it poses a lot of issues, but the focus is on having a transactional supported fixing, and the development of the new term rates, the forecasting, that is work in progress. I'm repeating myself, so I'll hand over to the other panelists to see if they've an insight or an input into that. That seems to be some of the questions. Where do you look for something? It probably doesn't exist yet. It might not exist.
I agree with you, Ben. We're very keen that the LIBOR replacement is not a quasi-LIBOR type rate where we're getting consensus information rather than basing it on transactions. So that's being reiterated time and time again, I think, by the governor.
Thanks, Catherine. And also, do you have any thoughts on how could people consider reducing litigation risk as even without Justin's magic powers?
Well, I think that, you know, I can't really opine on how to reduce litigation risk because, you know, people, you know, you need both parties or multiple parties to have a litigation event. And maybe this has been the theme of everything that we've discussed, is know your risk, be transparent, have discussions with your bilateral counterpart, participate in industry forums, read the Bank of England website, know your contractual rights, start talking now. Thinking of this as a future cliff, you know, that doesn't seem to be the prudent risk management.
Nicely put, Ben. Marcus, we have got you back. We are on the same question. So
yeah,
you mentioned litigation risk and you are seeing that and facing questions. Any thoughts?
I think, you know, how to avoid litigation risk is I think, I'm sure you've already mentioned it while I was offline, get started. The call to action now, the get started now, is the only way to have enough time to make sure that you can get things agreed. And, you know, and where issues are discovered, having the time to address them, whether that be, I came on at the end there, just Ben mentioning, talking about the industry forums and so on, being able to address issues, reach consensus, have a normalized approach forward so that people are going together and using similar approaches, which all helps to reduce that risk of litigation. You know, if you go off on your own, do something completely random that's based off whatever you happen to think, and you do it at the last minute when there's no chance to discuss it or to talk about it, that's a you know, a recipe for disaster. So partly back to what we said before, we all said before, is, you know, you need to start now, you need to understand your risk, you need to understand the contracts you have, what is in those and what needs to be changed, and you need to be reaching out to the counterparty to those contracts to start those discussions and negotiations as soon as possible.
And maybe Kumar, just in the interest of managing our litigation risk, just to be clear, this is not legal advice coming from this group. This is practical perspectives, I think, as we can, but yeah, everyone's going to have to follow their own counsel.
We should have a disclaimer on the bottom for that one, I think.
Thanks, Justin. Now, can I come to another group of questions that have come up is about how do you forecast the new alternative rates? What do you expect and when do you expect the liquidity in swap and derivative markets that will develop so that they can be used as a basis? And also, I think Ben has already alluded to this question before, is to how reliable are the forecasted rates published on Bloomberg? So Ben, since you have already, I think, mentioned it in the things, can I start with you on this one?
Yeah, I think that there's a number of different questions in here. Can you build a curve? You can always build a curve. Is the curve accurate? Becomes a question. And then, is there a forward rate? Is there a term rate? And there's a lot of reliance on term rates at the moment. So I think that this is evolving. You know, transaction support or liquidity supports valuation, transaction support valuations. There's a lot of SOFR activity. So you can see probably, you know, reasonable pricing of SOFR trades. But this is developing. It depends on what you need. And you know, it's work in progress. I feel like I'm repeating what I already said, which I'm known to do. So but I'll try and discipline myself. I think this is developing. There is liquidity in certain types of trades, but the non-linear market is developing. There's also a differentiation by different market. I think the sterling market, the sterling funding market has transitioned the most. and other markets are catching up with that. And we're proving the concepts in sterling, but we have not necessarily answered, the sterling nonlinear market. Yes, we've done some caps floors as an industry, but the full market hasn't transitioned yet. And the observability of the new rate, the old rate, when stop sells are going to have impacts. We're introducing a disruptive event. We haven't mapped out the future. This is something we're going to have to navigate.
Justin.
I think maybe just a couple of things that might be useful. In the US dollar market, right, I think for linear derivatives, the portion that is SOFR linked versus LIBOR linked is relatively small. But the size of the market is so huge that, put it in context, the volumes in SOFR traded notional compared to SONIA traded notional are about 1/3 of the SONIA market. So even though it's only 3% of the overall market, it's still sizable when you think about it compared to SONIA. If you look at the data that's been published around the CME term SOFR rate, I think they said the average volumes backing the 1 month term fixing were about $72 billion a day through the first quarter of this year. So to Ben's point, it is ramping up, it is building, there's some healthy numbers. And then just as an example, in the cash products for US dollar FRN issuances, for all bar one of the last 12 months, SOFR issuances have outstripped LIBOR issuances in US dollar. So there's definitely instruments there. You're seeing sort of 5-year plus deals going out in the FRN space. I think in the swap space, we saw from the auction last September that went off relatively without a hitch, and variances of less than a basis point on some of the auctions. So it continues to grow, but I think, as Ben said, the options markets still have a long way to go compared to linear space.
Marcus, any thoughts, especially from the UK perspective, what you're seeing?
I tend to agree with Justin that the SONIA market is probably more developed in those terms. I think also we're in a bit of a chicken and egg situation, which is, people don't want to transition because there's no market, but until people transition, they're not going to want to trade the derivatives that will create the market. And I think partly some of the work from the regulators is helping to push that along, because obviously with the cessation of issuance in LIBOR for new products, that's kind of forcing people to move into these markets. And I don't know, but I would hope and I would think, looking at the way it works, that that's going to sort of snowball over time. Ben's point about the non-linear markets, that's obviously it is a very different space. It'd be interesting to see how that plays out. But again, I think as more it tends to work its way up the complexity structure. So once you have a more active loan and bond market and then linear derivatives market, that will feed up. The question, I suppose, is probably how long is that going to take? And unfortunately, I don't have a crystal ball, so I don't have the answer to that one.
I think this also sheds light on another question which has is coming up. How are the markets for interest volatilities for the new RFRs developing? And I think, Marcus, to your point, this is with the non-linear side of the market where you are seeing some concerns. And also Justin mentioned, am I correct in saying that?
I think that's fair. I mean, I think we are it's starting is the obvious point, but I think it's the development of the market, to me, is something that has started in the more vanilla products. As I think we talked about non-linear derivatives, the swap space, and then obviously the loan issuance and the bond issuance that requires those derivatives to hedge. As you move into those, become more robust and more developed, then you'll move into more sophisticated and more complex products. So I think it's, again, most of these things, we're seeing term rates start to trade in the SONIA space. I know they've deferred this term SOFR for a little while, but that's clearly something people are pushing for. So it is happening. I guess the question is what pace is it happening? Is it fast enough? And when will we see? And the other question, I suppose, that's a bit of a how long's a piece of string, is when will people feel that there is enough liquidity, that they feel comfortable that there's enough liquidity? And that's going to be very much dependent on people's risk appetite and their view of the market and and so on. So it's there is this sort of it is a bit sort of self-referential, the whole thing.
Maybe an example from to Marcus's point around sort of the push versus pull. One of the things we did here earlier on in the start of this year is you started seeing more demand for Bermudan swaptions on US dollar, linked to a desire to hedge risks coming off some of the Fannie Mae and Freddie Mac issuances and the SOFR product there. So looking to handle the prepayment risk. So given we're in a situation where by the end of the year, there should be no new contracts entered into on US dollar LIBOR, I would think as you go through the second half of this year, to Marcus's point, we can hope, but as that cash product increases, as you see more demand coming through there, there's more hedging demand, there's more risk management demand, that would hopefully help catalyze how we see growth coming through thereafter.
Thanks, Justin. Just a quick question, and I know this again depends on what's being published and not. There is a question here asking about how reliable you all feel the rates published on some of the platforms that provide the data like Bloomberg and other sources are about the new alternative rates. Anyone?
Well, it depends on which rate you're talking about. So, you know, a lot of, I mean, the rates that are going into fixings tend to be very reliable because they're transaction based. So if you're looking at BISB or SONIA or Ionia or SOFR, that's a, you know, a robust methodology based on transactions and a defined set of transactions. We're still maybe SONIA. The liquidity in the US market is still indexed to LIBOR. So if you do a SOFR swap, you're going to be quoted as a spread to LIBOR. And that's going to change over time. And we've had some recent updates or requests or instructions from the ARC on affecting that change. But the markets, you know, there are functioning markets, there are good rates, and there are, say, pricing rates and observed fixings. The observed fixings are pretty determinative and accurate. And then the markets, it really depends on which rate, but you will get a good quote for a SOFR swap as a spread to LIBOR for whatever tenor you want to trade. I'm not market making that trade myself, but you know, there's a lot of information there. There's a lot of products that are there, but you know, not everything is liquid, and there may be a wide bid offer on certain trades, but you have enough information to build a curve. And at the moment, your curve, your SOFR curve probably should be a spread to LIBOR, but at some stage, liquidity is going to be concentrated on SOFR, and LIBOR for legacy products, exception products, could be or should be a spread to SOFR. Again, that's at some stage in the future. It's not there now.
Thanks, Ben. I think there are a couple more questions, given the time, I would like to go through. One, I think, just with the caveat, we shouldn't get into we are not giving accounting opinions or anything, but there is a question out here, is how do you see the impact of these changes on delta hedging strategies under IFRS 9 and 7? So Justin, can I come to you from that side, not going into the accounting? What do you think on the economic side? What are the consequences of that? And I think Marcus has also alluded to this in one of his previous discussions. So I'll start with you, Justin, and then I'll come to Marcus.
So maybe one area we've seen that come through as an example is in the take up of the ISDA protocol. And I think what we've tended to see is that there's been very strong take up amongst dealers, amongst financial institutions, around those that have a lot of derivative activity. It's been less strong with those that have a one or two or a small number of transactions that are basically there to hedge underlying loans. And I think that's one of the concerns and delays we're seeing, is that people want to make sure they can migrate both the loan and the swap at the same time and maintain their economic hedging. So I think it's an understandable question. I think the idea generally is to keep those hedge relationships, whether economic or accounting, as best you can through the transition. The other nuance you're starting to see is, as people look at hedging some of these RFR-based products, where there are slight differences between the cash instrument and the derivative and how those payoffs actually work. For example, the look back or the payment delay. Generally, I think what we're seeing is that people are looking to see if there's an ability to modify the swap and have maybe a slightly different convention to the cleared swap in order to make the hedging easier. We have heard of a couple of instances where customers have come looking for the loan to be customized to match exactly the cleared swap terms, and so capture sort of the more efficient cleared market and the swap space. So I think as you get into the details around it, there will still be an important need to hedge cash flows, hedge risks. We'll continue to see that coming through. I think getting into the details and understanding how significant are some of the differences, how significant are some of the nuances that you're looking through, are these things that would, how do you trade off some of the pricing choices, some of the operational choices, in terms of getting risk as exactly matched as possible, versus is there a premium that's worth it for you in terms of how to make that hedge work?
Thanks, Justin. That is useful. Marcus, anything to add quickly?
I think there's, in my mind, there's kind of two parts to this. One is the transition itself of the legacy assets. Both IASB and IFRS have come out with guidance and on what is acceptable as a contract modification that therefore won't break your hedge effectiveness on the transition date. So I think that's very helpful, but there are limitations on what that is applicable to. So it's one that, again, as I think we've probably the most repeated phrase so far during the thing, is be very well aware of what's in your specific contracts, because it will apply slightly differently to all of them. The going forward one, I think is where Justin's going, is obviously, if you've got different conventions in your cash products and your derivative hedge, that will have implications for your hedging reporting going forwards. So on a prospective basis, how you manage any sort of potential timing basis or rate basis is going to be very difficult at the moment to figure that out, because obviously there isn't as far as I know, there's not a basis swap you could trade that could make that risk go away. So if you're going to sort of start trying to match, do cash flow matching for hedge accounting or something like that, that may get a lot more complicated because of some of the timing issues and things like that, and because some of these issues are very much at a detail level. In terms of the time, how many days you look back, how when is the payment due versus when is the observation of the rate taken, and so on. The devil is in the detail, and I think we sound like a broken record. You need to be looking at the detail of your contract, understanding that, knowing the risk that is in there, what potential things you need to look for as you go through the transition. When we're talking to clients, we're saying to a lot of people, model it out, do the scenarios, test it, to make sure that you understand it and what's going to change and how that's going to work. Because otherwise, some very small difference in the modeling may be the thing that causes your hedge effectiveness to fall over in a year or two's time, and that the consequences at that point could be very, very dire.
Thanks, Marcus. I think we are nearly coming to the end, so I'll just float one question, and I think I'll start this with Ben, because I think you're also one of our board members on the FI board. And the question is a pretty interesting one. And what the question has been asked is that, given all the differences that we are seeing in different jurisdictions and how people are doing, what, in your view, is the impact of this on globally consistent valuations?
I don't know what globally consistent valuations really means. I think that there's information asymmetry across the globe. There are different risks. So, you have a risk-sensitive valuation. So, I don't know. The way we value and feel about a US Bermudan product Marcus mentioned earlier, or Justin mentioned earlier, and a Korean Bermudan. They may use the same model, but they're very different. A dollar berm traded in Australia should have the same value. Maybe there's a timing difference as a dollar berm traded in New York, but I really don't know what the concept of globally consistent valuations really means, because we have a globally inconsistent world. So I struggle to answer the question, but it's it's a nice idea to think that there's a giant ledger in the sky that sums to zero. But I think with information asymmetry and between counterparties and around the world, I don't think that ledger sums to zero.
Thanks, Ben. Anybody else? Any thoughts or views before we start moving towards closing this? I think everybody's tired of hearing us speak. I would like to now to bring this to an end. And first, thank you all for sharing your time and of course your expertise and your knowledge in the area. And also thanks to all the people who joined into the webinar. I know it's been at different times for different people, so really appreciate it. I think there's going to be a survey at the end of this. We would be grateful if you could fill it up for us, because it helps us improve how we do this next time going forward. So with that, I would say thank you all, and thank you for being with us.
Thanks, Kumar. If I could just pass on my thanks to the panel for an insightful and fascinating discussion. Just for the attendees, there will be a podcast and abridged version of this session available, which will be sent to you via email shortly. The paper that was referred to earlier in the session, the perspectives paper issued by the IVSC, was issued in February. It looks at the impact of LIBOR cessation on valuation, the valuation profession, and you can download this from the IVSC's website. As Kumar said, there'll be a short survey, so please give us your feedback. And finally, thank you to Duff & Phelps Kroll Business for sponsoring this webinar and the entire webinar series that we've hosted this month. And thank you to you for joining us today. Thank you.